The Federal Reserve has just announced a significant policy shift that's sending shockwaves through financial markets and directly impacting your wallet. After months of speculation about when interest rate cuts would begin, Fed officials have made it clear that borrowers shouldn't expect any relief until at least December 2024. This delay represents a major reversal from earlier projections, and it means higher borrowing costs will persist for considerably longer than many Americans had anticipated. What makes this announcement particularly significant is the Fed's reasoning behind the decision. Officials point to persistent inflation that remains stubbornly above their 2% target, suggesting the economy needs extended monetary tightness to bring price pressures under control. Wall Street analysts are now scrambling to revise their economic forecasts, with many warning that this prolonged period of elevated rates could trigger slower economic growth in the coming quarters. The implications for your mortgage are immediate and substantial. If you've been waiting on the sidelines hoping to refinance your home loan at lower rates, you'll likely be disappointed for many more months. Current mortgage rates are hovering in the 6 to 7% range, and without Fed rate cuts, lenders have little incentive to offer better terms to borrowers. For a typical home buyer financing a $400,000 property, this delay could mean paying an extra $200 to $300 per month compared to what rates might have been if cuts had begun earlier. Your car loan situation looks similarly bleak under this extended rate environment. Auto financing rates have climbed substantially, and dealers are passing these costs directly to consumers through higher monthly payments. A 5-year car loan that might have cost you $500 per month at lower rates could easily exceed $650 monthly in today's environment, representing an additional $9,000 in total interest over the life of the loan. Credit card holders face perhaps the most immediate pain from this announcement. The average credit card interest rate is already approaching 22%, which means the Fed's decision to keep rates elevated will likely push those rates even higher. If you carry a $5,000 balance on your credit card, you could be paying over $100 monthly in interest charges alone, with no relief in sight for months to come. Savers and investors, however, are finding some silver lining in this announcement. Bank savings accounts and money market funds continue to offer attractive yields that surpass what they've historically provided. You can still find savings accounts offering 5% annual percentage yield, making it a reasonable time to park cash in high-yield savings vehicles rather than taking investment risks in equities. The broader stock market has responded with considerable volatility to this Fed announcement. Major indices declined in the immediate aftermath, as investors worry that higher rates for longer will compress corporate profit margins and slow economic activity. Market strategists warn that companies relying on cheap financing to fund growth initiatives will face tougher financial conditions throughout the remainder of 2024. Student loan borrowers are also facing a tougher landscape as rates on new federal student loans remain tied to market conditions. Those planning to take out education loans should expect rates in the 5 to 6% range, significantly higher than the near-zero rates available just a few years ago. Financial aid advisors recommend that families start saving more aggressively for education expenses rather than relying entirely on borrowing. The job market implications of this rate decision could prove significant over the next several months. Economists worry that sustained higher borrowing costs may eventually force employers to slow hiring as consumer spending weakens and business investment declines. This could mean fewer job openings and potentially higher unemployment by the end of the year, which would fundamentally change the labor market dynamics we've seen recently. For anyone planning major financial decisions, whether that's buying a home, purchasing a vehicle, or consolidating debt, the message is clear. The Fed's December timeline for rate cuts means you should expect elevated borrowing costs for at least another 6 to 9 months, making it crucial to plan your finances accordingly and lock in favorable terms wherever possible before rates potentially climb even higher.